Hey everyone, it's Megan Weiss here, Keller Williams Portfolio and the Portfolio Profit Podcast here with my favorite, Peter Stewart.
Hey Megan.
Hello, thanks for coming in today. You are just such a stud, selling so much every year. And I think I just called you the king of Marion County, Indianapolis, and all investments.
I'll take it.
Okay, good. So since I have the king here, we're gonna dive deep into investments. But first, we just want to rehash our predictions when we last met about the market. So tell me when last time we talked, we said, "Holy smokes, we feel this energy."
Yeah, it was definitely building, and we were predicting a record-setting year, and it's trended that way. It's right on track. Should have bought a lottery ticket at that time too. So we're spot on.
We should have. We said, it was about February. We said, we've never felt this intensity this early. And there was some ups and downs, as we went through March and April because of what was going on in the world. But tell us a little bit about what your market has seen in base investments or retail in Indianapolis.
Yeah, this year, definitely trending high on investments. About 95, 96% of my business are investors, and it's usually more around 90%. So a little uptick there, but still have the standard of retail buyers and sellers as well. And a record-setting year. Last year was a record-setting year, and this year I'm 20% in terms of closings for the first half of the year, 20% above where I was last time. And GCI is about 50% higher than that. So yeah, it's kind of a backfire from that whole lawsuit that came out a couple of years ago, thinking they were going to take away commissions. And in fact, it actually had the opposite effect. But overall, yeah, sales are up. I mean, there's a ton of buyers out there. My buyers, the investors, 98% of them are remote, and they're coming from all over the place and primarily domestic, but we're getting a few international buyers as well. Israel, surprisingly, considering, not to get political or anything like that, but considering what's going on in that region, there's still a decent amount of investors looking to buy property here in the United States. So, I mean, I'm glad it hasn't completely shut down the country in that relationship, but they're out there. But again, primarily they're still coming from the U.S., a lot in California, the coastal markets.
Do you think the coastal markets see our 1% or 1.5%?
Definitely, that's a big driver. I mean, of course, California is a big one, but any of the coastal states or out west in general tend to be a lot more expensive. You're not getting the 1% rule there. So it's a combination of not being able to get cash flow with the long-term rental strategy, which was a lot of people do, combined with the fact that their home prices are up quite a bit over the last few years. So if they've owned for a while, they're probably sitting on a lot of equity in their property and they want to do something with it. So they'll tap into that with a HELOC, or if they've sold a property recently, whatever it is. So they have a lot of funds, they need to deploy them, and it makes no sense to keep them locally because they're just going to be losing money every month, almost regardless of what strategy they do, unless they get into the development world or things like that, which much bigger numbers there. Not everyone's ready for that, but your standard, normal investor wants to do typically a very easy buy and hold long-term rental. And yeah, again, out in those markets, they just don't make any sense. So they look to the Midwest, and then typically Indianapolis is sitting in the top of that list.
Yeah, it is. And I think that we enjoy it so much because we're investors ourselves. We work along with investors, and you kind of being boots on the ground. And I love that even though you have a full-time assistant and processor, you're always still willing to go and videos for your clients that come through your Bigger Pockets network. And just like me, we're boots on the ground. We're in it every day, full-time.
I'm headed there after this.
Yeah, you are. So I love seeing us working together and pushing the investment side, both in the retail and luxury space and also investments. I feel like all the numbers have increased for both of ourselves.
You're seeing it too in the higher end market?
Yeah, in our higher end market, our luxury, at the end of last year, I had 3 offers on one property that was a push price of $2.5 million.
Wow.
And so I believe people want to move, and they were pent up. And then after March, April, there was some positive increase in rates and in buyer confidence. And I think people are like, I want this community. I want lake life, or I want to just do it. I've been sitting on the fence for a couple years waiting for rates to go down.
Finally realized this is probably not going to happen for a while.
Not going to happen. So let's just do it. And I know we are very blessed to feel like we're in a bubble here in Hamilton County and Marion County, and that we've always seen real estate being stable, steady, and increasing.
It's some of the most stable real estate, I think, in the country. And that's one of the things that sell a lot of investors on is that stability. We are not a volatile market like a lot of the coastal markets are. It's great if you time it right, because the real estate values can shoot up in a very quick amount of time. But the second something goes wrong in the market or in the world, they're the first to drop as well. So you can really lose big as well. I tell most people I talk with that Indianapolis, but specifically Hamilton County and our A-class locations, most stable real estate you're ever going to find. You get the most bang for your buck here. I mean, for $400,000, you can buy a newly built home in one of the best communities in the country. Amazing schools, low crime, tons of amenities. And where else do you find that? You can barely buy a garage in the worst part of Los Angeles for $400,000.
You're so right, because I did have a Pulte new build in that low 400 range that feeds in HSE schools and 5 bedrooms. I mean, it's a decent quality production builder here with Pulte or Lennar or David Weekley or Taylor Morrison, which I've had experience in the last year in those price ranges. Yep. So it's a conservative buy. It's a long-term hold. You get price appreciation. You get cash flow. So if anything, we're just still seeing an increase in buyers wanting to come. And I think what we're trying to do here at Portfolio is increase the everyday local Indianapolis professional to invest in their own backyard.
Yeah, it's surprising actually how little the locals invest in their own community. They love living there, but for whatever reason, they don't. Again, the vast majority of my clients tend to come from out of state. Yeah. I have a few local ones, but the few and far between. And you'd be surprised because usually the hesitancy to enter our market is the fact that people don't know it. So those who know it, you would think it'd be a lot easier for them to do it, but there's still some hesitancy there. But I think the tide is shifting. I've definitely noticed an increase in my investors going for the A-class as well, trending a little away from cash flow into more of the stability and appreciation side of things, which again is rock solid in our A-class. I mean, they're not going to cash flow necessarily. The A-class single family homes, you're more in the appreciation, debt pay down, tax benefit realm. But for those higher income earners who can benefit from that, there actually is a lot of money to be made. It's just not on a cash flow net monthly type basis.
And I think a beginner investor can't understand that, but everybody else gets it. Yes. It's the long-term hold, and appreciation here is something almost 40 years between us that we've seen all over increase.
Prices are still appreciating this year. It's a small percentage, but I believe overall, I think we're up about 1.8, 1.9%. That means like all property types, our whole market, Indianapolis and the metro area. Still, if we're up, let's say clearly, nearly 2% in 1 year or in 6 months, then that's a close to 4% increase for the year, which given what's going on in the world and all of that, the uncertainty and challenges there with gas and everything, I think that's pretty darn good. I'll take it.
Yeah. What do you think the media is telling everybody about our market or general real estate is?
Well, general real estate, again, because I speak with so many people that are out of state, they have a very negative view of the market. They think it's a buyer's market. Yes. They think prices are down. That's true in a lot of markets, especially the more volatile ones. Yeah. Go to Austin, Texas. It's a buyer's market there. Prices are down, I believe, around 30%, something Florida like that. Too, right? Yeah. Florida's challenging. Here, it's the opposite. We've been in a seller's market since 2018. I don't see that changing anytime soon. Our list of price ratios, inventory level, or that's very high, inventory levels very low, and prices are trending up.
I love when realtors or influencers online say it's a buyer's market. Well, the data actually says it's not.
Yeah, exactly. It's not necessarily just my opinion. The data clearly shows it. I can run a report for you. It's going to put the numbers in front of you, and it's going to say strong seller's market. Yeah. Our inventory would literally have to triple just to get into the entry level buyer's market in. And there's no way that's happening. No. I can't say impossible. Everything's possible, but it's 99% not going to happen.
We haven't seen a decline, you and I, in any of our Hamilton County, Marion County, or surrounding Indianapolis areas on prices. It has only appreciated every year since we worked together.
Yeah. And it's not going to stop anytime soon. I mean, especially Carmel was just voted as the #1 place to live in the country again.
And that's where you live. And Fishers, number 2. Can't go wrong.
Westfield's on that list as well.
Yeah, Westfield's coming up. So busy with that youth sports Becca over there.
Well, and the Grand Sports Center, the Grand Space Center that they just broke ground on as well. It's $1 billion project.
Tell us about that, actually. I know a friend of working there.
But it's kind of, similar to the Grand Sports Complex. It's a huge, massive facility. It's going to be STEM focused, so science, technology, education, or engineering and math, whatever that stands for. They're going to have a realistic replica of the NASA control center, things like that. So it's really neat. So not only is it's got an educational component as well, which I like, and it's just a massive investment as well.
Oh yeah. And they're redoing downtown Westfield as well.
Yes, they've got grand plans. I've seen a few plans about some canal type setting where they're going to build. I don't want to say look like Venice, Italy necessarily, but kind of that style where you can, it's amazing what's happening in Westfield. I mean, they were the 6th fastest growing city a couple of years ago. I think 2022. And that hasn't slowed down either. I mean, the boom in our A class has been amazing. That's what contributes to that stability and into those prices to continue to go up.
And I know our friends at BW Construction are doing a massive development right downtown Westfield. That's going to probably some of the renderings that you looked at that we're really excited to bring to share next year and the forthcoming years. But all this development and all this market update just shows that the market is healthy. We are both having record-breaking years. Buyers want to buy. We don't have a lot of options for our buyers. If I had 3 houses with a pool in or around Weiss around $1 million, I would have 3 more sales this week because that's what everybody's looking for. They want a pool life or lake life. They want to, nurture their home and make it their home an amenity as well. I'm seeing a lot. So it's exciting. I don't think I've seen this busy of a July in a very long time.
My June was that way for sure. I'm slower on the closings at the beginning of this month, but they're kind of pushed towards the back and a few delays for various reasons. Mm-hmm. But yeah, and in the next week or two, are going to be very busy as well. So we'll catch right back up.
Weiss Group brought on about $4 million in listings just a week leading up to 4th of July. And I just feel like people were, okay, now it's our turn. It's like the second wave is what I feel for sellers, and buyers are ready for it. And as long as weather's good until October, we're going to be out there. So keep up this good weather. So I really wanted to dive deep into our investment world since you are the king of investments here in Indianapolis. And I think in the whole nation, we all love emailing you, texting and calling you whenever we need. And you're always so appreciative to send us your thoughts. But 2 things I wanted to ask you about your building that you purchased in Noblesville and your BRRRR method. I think nobody really understands at a high level the type of cash flow that you can do if you increase the value of your commercial building and do the BRRRR. So tell us a little bit about an update on that.
So yeah, I did a 1031 exchange last year, sold my last California property and 1031 into a 12-unit apartment building in Noblesville. It was relatively stable at the time, 95% occupancy, in decent condition, had some recent updates. But there was still a value add component. Rents were under market, and aesthetically, there were a few changes to be made to the property to help increase those rents and increase the tenant retention as well. So over the last 6 months, we made some improvements to the property. We put in a huge concrete pad in back, 2 commercial picnic tables, 2 commercial grills, a bike rack. So kind of the lifestyle amenities to get people to kind of hang out and enjoy their home a little more, make it more like a home than just a standard apartment building. We also cleaned up the interiors of the common areas, paint and things like that, and put a new sign out front. So had to make it my own a little bit. So we're now, as the renewals are coming up on leases, we're bumping up rents $100 to $150 per lease, and we're getting it. And that's exactly what I projected in my numbers. So regarding the BRRRR strategy, it's similar to what you see in the residential space, but on the commercial side, you're really increasing the value of the property based on your income. That's how you do it. It's a math formula. In residential real estate, you could put $1 million into a place, but if the income, the income doesn't matter. If no other properties like it are not, if they're not selling for $1 million, you're not going to get $1 million out of it. You're limited by those comparable sales. In commercial real estate, the value is you take the cap rate into effect, but it's what your income is. And so if you increase your rents, you're increasing the value of the property. So on a BRRRR style deal like this, I am doing twofold. One, increasing the amenities, just cleaning up the property and adding some value there, but increasing the rents. And so with the $150 increase per unit, we estimated it's going to increase the value of the property by about $250,000. And so, yeah, spending a fraction of that cleaning up the place to get those rents and spending a little time cycling through those leases to get to that renewal point, it's going to increase the value about $250,000, do a cash out refinance, pull that money out tax-free, and then use it to buy another one.
So in about 12 or 18 months from your first purchase of this commercial property, You think you'll be able to refinance it?
I'm going to wait, probably hit the 2-year mark because it's a 5-year loan. I have a great interest rate and all that, but I'm probably going to wait 2 years. So we're 8 months into it at this point. So a little bit of time. I want to get all those rents bumped up and maybe even have a second level of increase if the market, can support it in another year or so. The other side of the coin on that BRRRR strategy is it's not really that strategy, but it's another way to make money on that property is a cost segregation study. So the tax play underneath that as well. And that's really where the real money is made. Yeah. And a lot of people don't fully understand or even know about that strategy, let alone utilize it. But I'll make way more money on that property via the tax strategy than I will anything else.
That's amazing. Let's dive into that. So before we do, your BRRRR method on the commercial, will you explain a quick BRRRR?
Oh yeah. So it's buy, renovate, buy, rehab, rent, refinance, repeat.
Yeah, we know it. It's embedded in our heads, right?
It's like kind of like tongue twister. So basically you purchase a property that needs work, you renovate it, you clean it up, you get a renter in the property, and then you do a refinance, get your money out, and then you repeat the process because in a perfect BRRRR, you're getting all your money back. So it's technically an infinite return on any cash flow you might have after that. And then you can recycle that money over and over again. So to put quick numbers on it, if you buy a single family home for $100,000, you put $50,000 into it. If it's worth $200,000, you do a cash out refinance at, let's say 75% loan to value. Your loan is at $150K. So you put in $150K, you get that loan $150K. So zero money in the deal, and you have $50K in equity in the property that's just sitting there. And hopefully if the numbers have worked out well for you, it's also cash flowing. So that's why I say, even if it's $100 a month, because you have $0 in the deal, it's an infinite return. But yeah, so it does lower the cash flow because you want a high ARV or after repair value so you can get your money out, but it allows you to recycle that money so you can buy a lot more property. So you make up for it in volume versus, individual cash flow on each one. You then go do 5 or 10 of them and make a lot more money that way. And again, and have equity built into each one. And of course, over time, you got debt pay down, tax advantages, et cetera, on top of the cash flow you're getting. Yeah,
it's amazing. And if that was all too much, please feel free to call Peter and we'll break it down. But we love it. We do it so much. We talk to people about it. And I think it's a strategy a lot of people do in residential, but I don't think, people talk about it too much here in commercial. And I think there's a lot of opportunity in the commercial space right now.
Think of the residential world when they hear BRRRR. For whatever reason, you're right, they don't associate it with commercial, but you can absolutely do the exact same thing in commercial. And again, it's actually, in my opinion, easier to boost the value of that property because it's simple math. Yeah, you can over renovate a single family home or a residential property and not get that value. So your numbers don't work out right. And you may not get all your money back and you leave money in the deal. Because again, you're basically stuck with the values of similar properties in the area. Whereas in the commercial property, I have relatively complete control over that. And I'm not subject to the values of other properties to a degree. Of course, when I do a refinance, they do look at other values because there's an appraisal. But for the strict value of the property, it's math formula. That's it.
Yeah. And I think that a lot of people get scared about all of this kind of stuff. They don't understand it. But when a commercial BRRRR is based strictly on numbers and something that you can track and is a little bit more controllable than a retail BRRRR, depending on your experience. Almost easier. A little bigger numbers. Little big numbers. Yeah, that's really exciting. So if you do your BRRRR method on your commercial building in Noblesville, your apartment complex, in about 2 years, you could essentially pull out $250,000, $300,000.
Yeah. When I bought it, we put a little over $400 into it. So I won't get all that money back, but I'll get a substantial portion. And again, because that money is tax free, it's arguably like making, $400,000 or so pre-tax.
Oh, yeah. So let's talk about cost segregation because I love it. And I want to tell everyone about it if they own even just one rental property, commercial or residential. So you're going to cost seg your Noblesville building.
Yeah. So the report's actually already done. It's just as we did our taxes for 2025, it was on there. So the very short of it is cost segregation study accelerates the depreciation. They send an engineer through the property, look at every single thing from the fixtures to the flooring, walls, construction style, everything. And they accelerate the depreciation. And so you can take a huge chunk of depreciation up front. As an example, that Noblesville property, we paid $1.63 million for it. The cost segregation study is estimated to save me $350,000 in taxes. So I'm literally getting my money, almost all my money back through tax benefits. So I'm not, and that means I am not paying. If I owed $350,000 to Uncle Sam, I don't owe them anything at that point anymore. Yeah. So it's equal to cash in my pocket. So you take that, you combine it with the BRRRR strategy of making the 250, let's say. I mean, there's $600,000 that I just made by owning the property. I only put 400 into it. So now I'm up 200,000, and that's not taking the increase in the equity of the property into consideration at all either. You can make, people understand you can make so much more money on that commercial level. I mean, not knocking residential, of course, that's great. That's how you start. That's how I got to the commercial level. One step at a time, you build it up from there. But kind of the end goal is to get into that commercial space because the numbers become substantially larger. So yeah, you can make way more money on the cost segregation kind of tax play on that property than you can on just the actual cash flow. Because in just the cost segregation study is going to make me has made $350,000. You know how long that would take you to make on cash flow per door? I mean, a lot of people aim for $150, $200 per door a month of cash flow on a property. I mean, even if you have a duplex, $400 a month, $5,000 a year, it's going to take you a long time to make that, getting to the 6-figure level. So it's a widely underutilized strategy. Now, don't get me wrong. There's downsides to it as well. You can't go then sell the property next year because there's going to be that recapture that you're going to have to deal with. So it is great, but there's downsides to it as well. So just don't sell the property, number one, or when you do sell it, do another 1031 exchange. You kind of keep pushing that tax liability down the road. And eventually, it'll go away.
I love this cost seg discussion because I don't think a lot of people understand it. And it's a great way to offset your taxes, get that appreciation up front. And then if you go to sell in 5, 10, 15, 20 years, your kids do, you can just save all that savings and put it into a 1031 purchase. Yeah. So you roll the money into a next higher purchase. And
don't pay taxes on that sale. And it keeps compounding. You keep doing that over and over again. So yeah, the really advanced investors have done this, for decades, and they keep rolling the money over and over again. And the good thing too, as over time, so if you do that accelerated depreciation and you sell in 2 years, you got to pay a lot of that money back, essentially. That's the short answer there. But if you're holding it for 20, 30 years, you don't, because then you actually experience that depreciation that you took up front. Right. So you don't owe that. But of course, there's money that you can make on the sale that you then roll over to the next property, kick that can down the road when you 1031 it.
I like kicking that can. I think that's what I want to do for my family and generations to come. Okay. Well, this is all so enlightening, and I love talking to you about it because you're in it every day. And so for those of you who are interested in this, whether you're beginner, a middle, or super experienced, come talk to Peter because he's just a master at knowing all the things, and from residential to retail to sales. And then obviously as our investment king, it's just so nice you'll share your knowledge because you're doing it yourself. You're like you have your own Airbnbs, you've done the property rentals, single family here, and now you've on to the next level. So if I'm so proud to watch you. And so if you're in this, somewhere in this world, like he is willing to handhold you. And that's what I think is so cool about Portfolio is the collabing and sharing these kind of details. And what I've seen is people are coming. We host a real estate boot camp that kind of dives into these details on the last Thursday of every month here at our office. So we're at the Cross Point building. So if you guys are interested in starting at the beginning level, talking about flips, BRRRR method, what all this is, it's open to the public every Thursday, third Thursday of the month. So it's just for those professionals, young kids, the boomers, anything in between that just want to learn. Start there, call Peter, and we're going to watch you come back in a year and talk to you about this Noblesville increase in equity on your commercial building, increase on your rents, on your cash flow, cost seg. It's just amazing to see 3 different ways that you just created money.
Yeah, out of a single property.
Out of one property. That's awesome. So thank you for sharing, and God bless, because this is still going. This market, we got another 6 months. Oh my gosh. I think that buyers are going to keep buying all the way through Christmas. I've never seen it this steady, this consistent. in a very long time.
Got a lot of momentum in the market, and I don't see any signs of it slowing down anytime soon.
No. So we're always working. So call us, and we're here. We love to share our investment knowledge because we're doing it ourselves. And thanks for being such a good leader and sharing your details. Save some money, spend some money, retire soon, hopefully. That's the goal. All right. Thanks, Peter. Everyone, talk to you soon. If you need any help, reach out to us at any time. We'd love to see you and talk to you.